All right, hello everyone. This is the topic that I'm going to cover in the Tuesday's replacement lecture, but because some of you cannot come, I think it's better that I also record it or screencast it, well, record a screen, because it's not clear that the IT people will be able to set up the usual recording in our replacement lecture hall. So we'll talk about a very important topic here, which is financial markets and macroeconomy. And it's a very important topic because it's a combination of until recently, let's say last 10 years, a rather undeveloped area of macroeconomics. So combination of macro and financial frictions or financial markets. Now we know that from the experience of global financial crisis that we cannot have that financial system can cause or bring about a lot of instability and can cause economic downturns, or at least can have real economic effects, even though the system itself, of course, is a nominal system, so to say. So how can we think about it? So financial markets, of course, we already know that from previous lectures in this course, are very important, for example, for channeling investment and smoothing consumption. They are particularly important for small open economies because they allow them to separate consumption and income streams at an exogenous sort of rate. But financial development has also downsides, and so financial innovations can bring around risk, something which we have ignored until now. Because we have been focusing on the positive aspects of the financial development. All right, so fiscal and monetary policy should be used to also, that we will conclude, address issues that arise from financial fragility or stability. And this is very much an evolving issue. It's a very much issue, or these topics are in the forefront of both macroeconomic debate and more importantly, maybe policy making. But we will not develop a full model. We'll just develop partial story. I will later, if I'll have time, introduce a modeling approach that we can use to understand the importance or the causal structure of financial markets or components of financial markets that have brought about the global financial crisis, at least in a very stylized macro sense. And that's not part of the course book, but we will, if we have time, we will talk about it on Wednesday. Right. So, according to the optimistic view of financial systems, they have lots of benefits. So these would be some of the benefits: mobilization of savings, facilitation of efficient allocation of resources, reduction of agency costs. So the principal agent problem is kind of reduced by having a centralized banker, not central bank literally, but rather than every borrower monitoring every lender, the other way around, every lender monitoring every borrower, you can have a centralized capacity that reduces agency costs. It helps enhance innovation activities through this funding, and also shares risks. So if a bank invests in a lot of different diversified projects, then the risk will be diversified partially away. Excuse me. But of course, there's a skeptical, or well, there are downsides, skeptical approach. Financial development brings with it high systemic risks, unusually low savings because people rely on the ability to borrow, to leverage their own financial assets or real assets much more readily than they could without access to financial development. Further, you could argue that there is a suboptimally high allocation of workers in the financial sector, so everybody's trying to make a buck in finance, even though the sector itself may not be as productive, and the talent is being channeled away from other productive areas of the economy. into finance. And finally, you could discuss crises, and the crises is the last bullet point here. Or well, funding of inefficient firms can be achieved by very low borrowing rates or the funding rates. So if funding rates can be lowered dramatically by all kinds of financial innovation instruments for the bank, then the bank will be able to and willing to, in other words, will find it profitable to fund projects which normally would not be funded. I don't think it's a major problem, the second from the bottom, but the last one certainly is huge. So that's, generally speaking, there are crises which can result from financial firms' attitudes or approaches, and these crises can cause real economic harm. So now it's important to mention that as countries become richer, they also become more financially developed. Now the causality is unclear, and there's a large literature about that. But we can think of joint determination of these two, financial development and state of economic development, so in other words, GDP per capita. Is this good or bad? Well, if financial deepening increases systemic risk, then technological progress in the productive sector could extend the economy's production capacity and at the same time make the demand for funds much more broad-based. So if the financial deepening causes increase in systemic risk of the economy, so more increased likelihood of financial crises, then improvement in TFP in the productive sector could result in an improvement or decrease in the systemic risk by spreading the demand for funds across more broad-based institutions, namely firms, as opposed to just financial investments which can be easily unwound but are basically to some extent orthogonal in returns to firm funding or returns of firms. Oh yeah, the first point, actually these 3 points are not that important, but the first point isn't that clear, right? The second one is something I already mentioned on the previous slide. If there are too many workers who want to go to finance and they cannot be used somewhere else. So skilled workers, math PhDs ending up working in financial institutions may be, so from a social point of view, suboptimal, and it may create socially inefficiently high wages in the financial sector, and socially suboptimally or inefficiently low wages in the productive sectors such as manufacturing. Or any other productive sector. So, yeah. And often it's said that financial innovations such as credit cards reduce savings, and then technological progress in the real sector may have the opposite effect. So, increase in wealth can result in increase in savings. It doesn't have to, because it really depends on when is this wealth increase happening and the time path of this wealth increase, which is the topic that we've discussed already. And that is what would determine whether savings will be reduced or not reduced as a result of a positive technological progress. All right, so the easiest way to impose financial frictions affecting the individual allocations is to just put in a borrowing constraint and see what the implication of a borrowing constraint, which is a type of a financial friction, is on the allocation of consumption and so on and so forth. All right, so let's assume that the individual lives for 2 periods and works in both periods. So this is exactly the model that we had before, right? Except we have very simplistic utility function. So we have a log utility in consumption and a CES aggregate of utility of, well, this utility of labor. And that is true both in the current period and in the future period, and this is an overlapping generation. There are 2 budget constraints. The first one is the budget constraint in period 1, where W times L is labor income. And second constraint is the income constraint, budget constraint period 2, where W T plus 1, L2 T plus 1 is the second generation's labor income, where we are obviously allowing both generations to work. So young and old both are working. So we can substitute, well, for C1 and C2 in the utility function, which is done here. All right. So for C1 from the first equation number 2, I can express C1 as W1 L1 minus S, and that's what is here. For C2, it's this other thing. So for C2, it's just 1 plus R T plus 1 times S plus the tomorrow's savings plus tomorrow's wage income. Alright, so if we assume perfect certainty, then we can just optimize this, right? So I substituted away for consumption period 1 and consumption period 2, and that eliminates C1 and C2 as a maximand, but we nevertheless still have several variables that we need to maximize. Well, in this case, just one variable we need to maximize. Well, no, we need labor as well. So 3 variables we need to maximize with respect to taking prices as given. The first order condition for savings is just a partial derivative of that expression of the Lagrangian with respect to savings, and it can be expressed as so this log of WL minus S, the derivative of a log is 1 minus what's inside, and then the derivative of the derivative of the expression with respect to S is in the numerator. So a chain rule. So it's just minus 1 divided by WL minus S, W1L minus S, right? And then we have the second one. Well, so first we have, savings is only present here, so the importance of savings for tomorrow's consumption is there. Again, we need to include the discount factor, so 1 over 1 plus theta. Then we do 1 divided by what's inside of the log, which is this bit here. And then we differentiate the guts of the log with respect to S, so that just ends up being 1 plus RT plus 1. And that allows us to express savings. So in this equation, since the first order condition is equal to 0, I can multiply both sides by 1 plus theta, and I can put, well, maybe I should multiply by minus 1 plus theta, so that ends up with the following expression. So I can just multiply them out, and you get this equation in the one before the last line. And finally, I can simplify that expression by collecting RT plus 1 times S in both sides of this equation and putting them in here. So that's why the 1 plus theta becomes 2 plus theta, because we added one more 1 plus RT plus 1 times S. So it is present here as well as here. Right? So it's a little more complicated to derive, but not too bad. Alright, so that's the savings. The savings is just the usual expression that we've had. And here it's a little bit more complicated because our lifetime income is actually coming from both periods, unlike what it was in other some other models that we've looked at. But nevertheless, the general intuition is the same. So optimal saving depends positively on labor income when the individual is young, and it depends negatively, so there's a minus in front of the second part, on the tomorrow's income or labor income when old, which also makes perfect sense, because if you are expecting to be rich when you're old, well, there's less reason to save, right? So the individual will then decide optimally how much to work, given these exogenous, from the point of view of the individual consumer or capital owner, this individual Alright, I kind of choked up there. So basically, S can be positive or negative. One example where it could be negative is that the situation in which you're only working when you're old, and you're not working when you're young, right? So if WTL1T is 0, then WT plus 1, LT plus 1, L2T plus 1 is going to be positive optimally, and consequently savings is going to be negative. So, it's an optimal savings coming from consumer optimization problem. In a closed economy setting, what we need to model a financial market, therefore, are both borrowers and savers. Otherwise, we are not going to be able to model financial market sufficiently realistically, right? So we therefore need some kind of heterogeneous models, models which have different types of individuals, some of which are savers, some of which are borrowers, right? And that is necessary in order to have a positive capital accumulation equilibrium, so the financial market has to actually function. Okay, so assume that both wages are such that the savings is negative, or in other words, it is optimal for the individual to borrow when they're young, and this allows them to increase their utility. So in a perfectly functioning financial system, that equation which we just had, which is this replicated here again, would be the optimal amount of savings that this individual would like to make, and in this case it would be borrowings. But what this ignores is that the financial markets and financial sector is not perfect, and one such most simple realistic complication is that there is some kind of screening and monitoring of borrowers that needs to be done by the bank, and that this is costly. So bank doesn't just give money to everyone that at this given interest rate. They also do screening and monitoring of applicants and also existing loans to ensure that their loans get sufficiently high likelihood of repayment. Right, so, but this is costly. Right? So what happens if we model monitoring or screening cost? Well, basically there will be less saving, there will be less borrowing as well. So there will be there's going to be a tax on transactions, and the transactions are going to be, the volume of transaction is going to be decreased. Okay, so let's think of another imperfection, or one particular type of imperfection, which is a borrowing constraint. So your saving has to be bigger than some amount, and you could analyze this maybe more simply, at least in the case of small open economy, with the slides, the graphical analysis slides of the small open economy. And we can think of financial development as relaxing this budget, or this borrowing constraint, right? So without any banks, of course, nobody would borrow, or it would be difficult to borrow, but you would still be able to save simply by putting money in the mattress. So the saving would be, the amount of savings would be bounded from below, maybe by 0, right? And so this lower bound can be reduced to negative territory, so that you can borrow if the financial sector is more developed. And so that's one way of modeling financial development, is to say that this borrowing constraint, which is modeled, for example, by a lower bound on savings, can be further reduced. Another way of introducing financial friction is to look at the aggregate economy. So, example, assume that wages are such that the savings are going to be positive, but these savings cannot be directly transformed into capital. So the financial intermediaries allow this transformation, basically. So it's unrealistic to say what we have been assuming until now, that the savings directly translates into capital stock. So typically what we were skipping was the financial sector. So if we model the financial sector, and you can model it quite rigorously, you are going to be putting into financial intermediaries in between the savers and the borrowers. And in that sector, you could model different aspects. One such is that there's an actual return which we have described until now as 1 plus RT plus 1 times the amount of savings. But we can make it more realistic by saying that not all of this is going to be received, because some of it may be simply not repaid. Some of the principal, there is a risk of non-repayment on defaulting on the loan and so on and so forth. And in order to minimize this risk, or at least lower it, banks have an incentive to engage in costly screening of the borrowers, which are in this case the producers. But how can they recoup this cost? Well, we can say that in fact only a fraction. So the reward to the bank can be in the form of a fraction of the gross return on the savings. Right? So that's the reward which funds, and here's denoted as phi less than 1. It's a reward which funds the screening and monitoring, which allows financial intermediates to operate actually and to allocate these funds to the right kinds of firms. Right. So how do we take into account the fact that there is this cost additionally? Well, we could put it, we could just multiply it by the interest rate, the net, or the lowercase r, so the net interest rate, when we express our budget constraint, right? So the budget constraint in the second period is what you've saved plus the interest, and your income on the work is going to determine how much you can consume. But we could have a complication, in this case, this real life complication of some kind of a fee, phi, and so that fee has to be paid. So by these savers, effectively to the bank, or the banks are charging someone in order to recoup the costs of monitoring and screening, and therefore the returns on savings are actually lower, because these are returns net of all costs. So these are returns that are available to consumers to the consumers to consume, and therefore they have to take into account or subtract from the overall amount the amount of costly monitoring, or costs of monitoring and screening, and that amount is just phi, so it has to be subtracted. So minus phi, that times the interest payment times the amount of savings that we have saved. Now, if you remember, there is a capital market clearing condition in overlapping generations models, which typically has this form of KT plus 1 equals S times NT, where capital NT is the amount of workers in the savers, which are the first year workers in this assumed case. And so the gross demand for capital equals the gross supply of capital. Now here, because this monitoring cost enters or lowers the amount of money available to the suppliers or the savers, who are assumed to pay this monitoring cost in order to allocate their money to profitable ends. Because of that, only 1 minus phi of the supply of funds is actually available for investment. So is available as component of as part of K. So this is how we would normally rewrite a market clearing condition for the capital demand supply, or for capital markets. Okay, so the individual's behavior is going to be distorted as a result. First of all, the interest rate the interest rate of the saver is going to receive is going to be lower due to the excessive risk taking ex ante, and as a result of the necessity to monitor. The return that the regular saver is going to get is going to be lower, and that's going to discourage saving to some degree. At the same time, there would be a rise to excessive risk taking due to large leverage, to exposure to risky assets, financial fragility, or fragile liability compositions. So having liabilities all in just one basket. So the liabilities from the point of view of the bank are the deposits. So if your funding is completely coming from one source, that could be trouble down the road, so to say. Okay. There could be lots of negative asset price externalities, and this is something which we see. So it's an externality in the sense that this excessive borrowing has resulted in due to the financial development, has resulted in investment in risky projects such as houses or house price bubble. And these can, if it's a bubble indeed, or to the extent that they can create these increases in asset prices can be quickly reversed, such externalities are negative. And to the extent that these may amplify ups and downs in consumption, or aggregate consumption of households, such externalities are actually causing or may cause the economic cycles to be amplified. So in an expansion, they could contribute to further increase in the expansion by excessive borrowing borrowing and investment, some of which may be speculative, and in the contraction it might be the opposite. So everybody's withdrawing their investments in addition to the economic contraction that lowers the prices of assets further and has a negative wealth effect as well. So they can amplify the ups as well as the downs. They can cause distortions in the composition of output, where there's too much consumption or too much savings or too much investment, depending on what scenario we look at. If the central bank is interested in maximizing the welfare of the population, they should take this into account if there are externalities of different kinds, and that's what the central banks nowadays do. So they create some kind of financial stability goal for monetary policy, and this is going to be highlighted by the global financial crisis, of course, as a backdrop, which showed that the instability of the financial system can result in large economic losses. Considerable international focus has resulted in reducing the risks to the financial system. They can be results of various aspects: the buildup of debt, excess credit, asset price growth, and they arise also from the financial system's reliance on unstable sources of funding potentially, right? So, and all of these things are potentially problematic. And finally, the systemic nature. So banks are interconnected very strongly, and consequently managing risks of financial system as a whole can be more complicated than just some of the difficulties of managing risks for each individual bank, because these exposures are often very large and held cross bank borders, if you like, and so they can spread as a result of that very easily. So it used to be the case that you had macro policy in central banking and you have prudential policy, where the prudential policy would be policy which tries, microeconomic policy which tries to address idiosyncratic risks, whereas the macro policy would be price stability, anything that results in price stability in economic activity. But it missed until GFC, basically this point in the middle, in the bottom of the figure, which is to say that there is something called Macro-Prudential Policy, which takes into account the consequences of macroeconomic actions on financial sector and consequently on the macroeconomy. All right, so the main component of this is the financial stability and two components and systemic risks, and these policies are called macroprudential. So macroprudential policy are policies that take into account the financial sector's architecture, and they want to they are aimed at maintaining good macroeconomic performance while at the same time providing the right regulatory instruments to help lower the systemic or system-wide risks which can develop or result in the development of these financial and possibly business cycles. And so the goal of the policy is to build additional resilience in the case of crisis, basically, particularly in the financial systems, and dampening excessive growth in credit and asset prices. So there are things that the central banks can do but they are not the standard policy toolbox. Right, so what are some indicators here of systemic risk, I should say? So capital structure, the second one, is very common. So if your capital is if you don't have enough capital compared to your assets, then you are relatively risky or too risky, and that can spread across different banks, as we have seen in global financial crisis. Total assets and their composition, or financial accounting aspects. Ratio of credit to GDP is quite common. Real asset prices also common, but not as much. Ratio of non-core to core liabilities in the banking sector, I'm not sure about that one. Interconnectedness across industries, and the value of institutions trading securities and securities available for sale. Yeah, I think those are the main indicators. Now, the macro-prudential tools is something that you need to know for the exam. So, cap on loan-to-value ratio, cap on debt-to-income ratio. We'll talk about these on the next slide. Countercyclical capital requirements. So these are the Basel Accord requirements. Cap on leverage. So we will talk about that maybe on Wednesday if we have time. To what extent is leverage, it turns out, is quite important in propagating ups and downs internationally. So limiting leverage can cause less propagation, which may be a good thing in a very hectic world, but it may be a bad thing in a very sort of placid world. Time-varying reserve requirements, that's kind of Basel Accord requirements. So in a boom, you are required to put aside more risky capital, and that will help buffer your possible downfall in the bust. Yeah, and that's pretty much it. Now, in New Zealand, we have the countercyclical capital buffer. So in an upturn, so I said it the wrong way around, countercyclical capital buffer, so you need to have more capital in a downturn than you have in an upturn. Why is that the case? Because the sales can lead to fire sales, which can lead to dramatic drops in value of your assets, which need to be picked up unless you want to shrink your balance sheet. These need to be picked up by increases in capital, the amount of capital stock, because both of these are offsetting each other in principle on the asset side of the bank's balance sheet. Core funding ratio is another macro-prudential tool. Sectoral capital requirements, which vary across sectors. So, investment in different sectors requires, depending on riskiness of the sector, requires the bank to hold differing amounts of capital stock against the loans that are being issued in those sectors. And most famously, I guess, is the restriction on high loan-to-value ratio, LVR, for residential mortgage lending. That's the most common one, the most up in the news one, which has just risen or is going to rise in October again. The restrictions are going to get more stringent. Right. Another role, which is not directly macro-prudential, but it's the case when macro-prudential policy may fail or not completely stop the spread of crisis, is the role of central bank as a lender of last resort. And that's what the Fed has done throughout the global financial crisis, as well as the ECB, and in the aftermath of the global financial crisis. So supplying liquidity to the financially constrained institutions, reduces the lending rate effectively, and that's the main role. Now, of course, the fiscal policy can also, government and the fiscal policy can also stimulate the economy and help the banking sector through increasing government spending or cutting taxes transitorily, right? But that's not what we're focusing on here. Okay, so let me have a little break. So the financial stability policy, so macro-prudential policy instruments, and lender of last resort, sort of stopgap measures that help the economy avoid a crisis or get through a crisis, have unfortunately also negative consequences. In this case, we'll just highlight three. The first one is sort of moral hazard aspect, which is when the banks know that you're going to supply liquidity to bail them out, so to speak, or at least help them to get through the crisis, they will act accordingly and in the good times, and that is to say they will overborrow and they will overinvest and they will increase this financial fragility simply as a rational response to the situation in which they know or they expect to be bailed out or somehow assisted by the government. Secondly, monetary policy stimulus can reduce interest rates, which may be reduced all the way to zero, in which case monetary policy is not going to be very powerful. And finally, a fiscal stimulus contributes to the accumulation of public debt and therefore excess burden of future generations. So this is more of a redistribution from today's generations to future generations. And then also there is this international aspect. So the globalization is a fact of life, particularly in the financial sectors, and that results in transmission of macroprudential policy tools or policies between countries, where some people call it the race to the bottom, or the race to of financial institution to the easiest, least regulated entity, since they can, or country, since they can actually operate from anywhere in the world nowadays. So lots of actual real life situations. This would justify a course in its own right of monetary and financial policies, or money and banking kind of course, more up to date with the global financial crisis. Something that you can take actually in honors courses if you end up doing honors. And so finally, let me just conclude. There are financial systems around us in every country, and they form an important part of our economic system. But the devil's in the details, so to speak. So the structure is what underpins its risks, and these structures can have both evolved over time, and that's just generally speaking the financial deepening, but also they're different. They're heterogeneous across countries. And as a consequence, the world experiences a period of financial crises which impose significant economic costs or well-being costs on the whole country. So macroprudential tools are being developed to enhance this financial stability and avoid the proneness of financial sector to crises, to repeated crises. So this is basically what we will be examining when it comes to financial macro interactions, but it seems like I may have time to go on Wednesday, the last lecture, over some notes which will actually be much more clearly and precisely discussing the interconnections between macro and financial sector in the light of the global financial crisis. So that should be more interesting. But here what you need to know are the macro-prudential measures and the macro-prudential policies and what they are, how they fit in, and why they are there.